I want to turn now to Lindsey Piegza, who is chief economist at Stifel, to get her thoughts on all of this. So, Lindsey, I want to hone in on what the Fed had to say about inflation in the statement. Quote, inflation has risen largely reflecting transitory factors. There's that word again, transitory. Is it time for the Fed to start to more clearly define what transitory means so that we have some sort of a timeline to work off of?
Well, certainly the market would appreciate some specifics in terms of what the Fed means when it says transitory. But broadly speaking, there is a lot of evidence to support the Fed's thesis that these price pressures will eventually prove temporary. What we see is the vast majority of the uptick in costs is highly concentrated in areas that were hardest hit by the pandemic. So the expectation is going forward, as the economy eventually recalibrates, producers ramp up supply to meet that pent-up demand on the demand side. Well, then we start to see price pressures abate. But what I don't think the Fed is accounting for, and maybe this goes back to some of the comments we've heard from Fed officials about wage pressures occurring faster and potentially being more persistent than expected, is the wage side of the equation. Wages have risen quite dramatically and tend to be more sticky than price increases as a result of supply chain disruptions or base effects.
Hey, Lindsey, it's Adam. We just had a guest tell us that the repo world and repo desks are an alternative universe. And he also said that those of us in the real world, we won't really notice the impact of what's going on. But what is this signal the Fed is sending by establishing this standing repo? Is it a red flag? Is it a warning that the system could get gummed up in the future?
I think it's the Fed being overly cautious, increasingly concerned that they want to be able to make sure that financial markets remain liquid, that they continue to function properly. So I think this speaks to the Fed's very patient stance, as they've had all along, that risks do remain both to the recovery and to financial markets. And if they see any sort of headwinds or any sort of barriers going forward, they're still very much in a position to provide additional accommodation. Now, I know they've said we've taken steps towards that further substantial progress threshold needed to make a change in policy, but we're not there yet. And until we get there, the Fed is still very much focused on maintaining the recovery and keeping financial markets functioning smoothly.
Lindsey, I want to ask about the Delta variant right now. Of course, we are seeing the Fed just moving, at least in terms of their language, about the progress that we are seeing in the economic recovery. But as we are seeing right now with the Delta variant and some of the guidance that we've been getting, it could essentially be a headwind to that progress and to that recovery. I'm curious to know what you're making here of some of the surges that we are seeing, and if you think that this could trip up some of that progress that we have been seeing so far.
Absolutely. As we see the number of cases rise, there is an increased concern that we will go backwards instead of towards a new normal. Now, given that the shutdown is still very fresh on many Americans' minds, I don't see state and local officials imposing the onerous restrictions that we saw last year. But even if there isn't an official decree, a legal decree, we may see the recovery slow if Americans themselves choose to change behaviors. If people are fearful of contracting the Delta variant or COVID-19 in general, they may not go into crowded spaces. So hitting restaurants, hotels, the travel industries, the very industries that were hardest hit. We may also see people slow to return to work, exacerbating the labor supply shortfall that we've seen. Some businesses may be hesitant to reopen, or they may not require workers to come back into the office. And then you have the restaurants, the boutiques, the dry cleaners, all reliant on office workers' business. They too then are slowed in terms of their recovery. So the Delta variant and the rising level of fear around contracting the virus certainly remains a headwind to the recovery as we look out to the end of the year.
Lindsey, back to those asset bond purchases for a moment. I know that some Fed officials have said they're willing to entertain cutting back on those mortgage-backed securities first. Right now, they're buying up about $40 billion worth per month at a time when the housing market is booming. Do you think that that would be smart for them to pare back the mortgage securities before anything else?
Well, there's certainly an argument. As you just said, the housing market is booming. So there's a number of Fed officials that say, look, we don't need to be providing any support to the housing market. So let's focus on rolling back mortgage-backed security purchases first and foremost. There's other Fed officials that say, wait a minute, there's a very clear precedent to roll back to roll back asset purchases in a very uniform way, whereas you taper treasuries and mortgages at the same pace. And by changing that precedent, we may be sending an unintended signal to the marketplace. So this is one of the discussions that's very much ongoing surrounding taper, some of the details. But I think first and foremost, market participants are looking for more of an indication of timing as opposed to exactly how the taper is going to occur.
Lindsey, I was just curious, if you were part of the press conference when people get to grill the chair, is there a particular question you would ask the chair?
Oh, certainly, but I don't think I'd get a great answer. When is taper going to begin? I think, again, the market would really like to understand when the Fed intends to begin to roll back those asset purchases. Now, again, the Fed has said they're waiting for substantial further progress. We've taken a step towards that threshold, but beyond that, we really don't have a good sense. I would expect the Fed to continue to jawbone the market towards an acceptance of an outline in the August-September timeframe. That would give the market ample notification before a formal announcement came out at the end of the year. So we're literally looking for taper to be a 2022 event. And of course, if you assume about 6 to 12 months of tapering, getting us well into the process before that first rate increase, that puts liftoff in 2023 or beyond. So we're still quite a ways away before we talk about the Fed removing accommodation. But again, if I was at that press conference, I would certainly like to press the chairman on giving some specifics in terms of the timeline.
Absolutely. I think a lot of people are looking for some more specifics. Lindsey Piegza, Stifel's chief economist, thanks so much for joining us.